Hi, I'm Billy Gwaltney, and this is the CYA Podcast. This show is for the physician who understands the importance of protecting everything you've worked so hard to achieve. Each week, I'll bring you tips and advice to help you cut through the clutter and misinformation and show you exactly what you need to preserve your income and way of life. If you're ready to achieve the peace of mind that only financial security can bring, let's get started. Welcome to today's episode of the Cover Your Assets podcast. This is Billy Gwaltney, and as always, I'm very happy to be with you today. Today, we're going to cover Guardian's Future Insurability Option. So in brokering specialty disability coverage with thousands of physicians across the country, Guardian is one of the top tier contracts. If structured properly and purchased typically when someone's in training, but even after they've graduated and are in attending, the policy could include the ability to increase coverage as your income goes up without having to redo any medical screening and with the same discount and premium structure in place at the time you bought it. Guardian has two options on their contract to allow you to increase coverage, like a couple of other companies where you can pick up front which one you prefer. The first one is called the Benefit Purchase Option Rider, or BPO rider. And that's what allows you to increase coverage as your income goes up. There's no ongoing cost for this rider. So they're technically giving it to you. You do have to opt in for it. You have to make sure it's on your policy. They don't give it to everybody. But if it's on your policy, then there would not be an ongoing fee for it. And the way it works is every 3 years, you are eligible for additional coverage based on your income, your pre-tax salary, total earned income at that point, and also factoring in any group long-term disability that you may have through an employer and other disability coverage that's private. As we've covered in a number of other podcasts, there's a formula that companies use to determine how much coverage they can purchase based on their income at any point in time. So Guardian, for instance, has a total cap of that they'll allow one physician to have in terms of coverage of either $20,000 or $30,000 per month, depending on your specialty, and there may be some state limitations. The company won't give you $20,000 or $30,000 just because you're willing to pay the premium for that. They don't want anybody overinsured if they can help it. And so they run this formula. If you have the benefit purchase option rider on your policy, they do that every 3 years. And then any additional coverage you're eligible for, they require you to accept at least 50% of that additional amount in order to keep the rider on the policy. If you do not accept at least 50%, then they'll remove the benefit purchase option from the policy. Also, if your income hasn't increased and you think you don't need to do it because you know you're not eligible for more, you still, if that 3-year anniversary comes up, you still need to go through the steps, which are quick, and it doesn't take very long, but you still need to do them. Or they'll also remove the rider. So not communicating with them would not keep the rider on the policy. It actually would have it removed. There are exceptions to when they'll allow you to increase coverage without having to wait for that 3-year anniversary. Certain triggering events, so to speak, like if your income increases significantly or you lose an employer-sponsored group LTD policy, they'll let you activate additional coverage quicker than inside that 3-year time frame. And so graduating, if someone purchases a policy with Guardian and they graduate a year later or 2 years later and become an attending, you don't have to wait for that 3-year anniversary to increase. You can do it right away because that would be one of these triggering events. But generally over the course of your career, you're going to be eligible to increase every 3 years. And you just kind of get in that groove of knowing that you'll be going through that in that time frame. Again, there's no ongoing fee for this rider on your policy. Okay, so since they're quote unquote giving it to you without you paying a fee, they kind of design the guardrails that you're gonna access coverage around. Okay, so they kind of call the shots. The other option that Guardian offers is what's called a Future Insurability Option, which is a rider that you opt for and you pay for it. There is a fee for that you pay up front when you purchase your policy. So if you're comparing Guardian quotes and one has the Future Insurability Option rider on it, that policy, if everything else is the same, is going to cost more than a policy with the benefit purchase option rider on it, okay? And you go, well, why would someone pay for this FIO rider, Future Insurability Option rider, when they can get the benefit purchase option for free? Well, the reason would be that you're paying the fee and therefore you call more of the shots, which means that you don't have to wait 3 years. There's no 50% requirement on really any policy anniversary. They'll let you increase coverage as your income goes up, and you can take it or leave it. So no one else is telling you when and how you have to increase coverage. You decide that. Now, there are guardrails around the future insurability option as you get older, but generally for most of our clients that are physicians that are purchasing this at a younger age, typically in training, or even if they're an attending, they're usually earlier in their career, you'll want to typically the desire is to ramp up coverage relatively quick as their income increases through productivity and making partner and a number of other things as you find your groove in your career. And as that happens, you can do it both with the benefit purchase option rider where there's no fee and with the future insurability option rider where there is a fee, but there are trade-offs for both. I have found that clients typically are okay with the guardrails, so to speak, around the benefit purchase rider in exchange for them paying a lower premium up front. Usually in training, budgets are at least being watched pretty closely, if not really restricted and tight. And so saving $20 or $30 a month on a premium adds up. And so there can be a pretty decent savings if you're willing to kind of go by the rules that they put in place. Again, you'll be able to activate coverage soon as your income goes up as an attending. That's not the issue. The issue would be over the course of your career. If you decided you weren't ready to increase coverage, then you would still at least need to do 50% if you have that benefit purchase option rider on your policy, or they're going to take it off the policy. The downside to having it removed from your policy is that if you ever need additional coverage in the future, you have to start from scratch. You have to revisit the medical screening based on your age at that point and the state you live in at that point, and there may not be the same discounts in place or available to you. The exception to the benefit purchase option rider is that if you are purchasing coverage in a state other than California and then moving to California. So as a general rule, you're covered when we work with clients and they purchase their private specialty coverage from us, you're covered wherever you move, okay, wherever you live. But the state that you live in when you buy the policy determines the rate you pay. And that's fine. That's just the way it is. California, pretty much across the board, costs anywhere from 20 to 30% more. So for people who purchase as a resident or living in California. So clients that train outside of California and then go to California to work as an attending or to do fellowship, it's advisable to get your coverage before you get to California because you'll be covered in California, but you'll always pay the rate for the state that you bought it in before you got to California. And it doesn't matter what state it is, it's going to be less than California. The caveat to the benefit purchase option rider on your policy is you may have bought it in a state other than California, but if you're an attending in California and then increase coverage through that policy, the additional coverage you purchase at that point will be based on California. It's based on the state you live in when you do the increase. So the only place that's really a concern would be in California where you'll experience some sticker shock. Again, I say this pretty routinely. I'm not trying to say that it's going to keep you from getting insurance or saving for retirement or doing things and living a lifestyle you want to live. But you would just notice whatever rate you're paying for the state you bought it in before you got to California, you're going to notice a pretty hefty increase in the same amount of coverage. It's just going to cost more per unit. And so that's the downside to the benefit purchase option rider. The future insurability option with Guardian would be always based on the state you bought it in when you bought the policy. So even if you do the increase in California, the rate would be based on the state you bought the original policy in. And so it would cost less. So that would be a point where it makes sense to pay more for the future insurability option up front, knowing if you know that you're going to move to California because the cost savings and keeping that same state other than California as the rate you pay for the life of your policy is going to far exceed any additional cost you may have had in the meantime for the future insurability option. Hope this makes sense. I know that's a lot to digest as you're listening to it. I'm happy to discuss your situation in more detail if it would be helpful. Please feel free to reach out to me, text me, call me, and we can arrange a conversation. My number is 704-270-2376. Again, 704-270-2376. Until we meet again, this is Billy Gwaltney. Thank you, as always, for carving out a few minutes.
This is thepodcastfactory.com.